Hi, this is David Duty with Common Sense Options, and we're on lesson number 34, which is on guts, and we're looking at coffee for May 2011. Now, I've increased the account size. I've been using 10,000 for an account, and here's an account I've added and started with 20,000 only because it's a coffee contract. You can't trade coffee with a small account. I don't care whether you're trading options or futures or whatever. If you don't have a larger account, stay away from coffee. And let me give you an example of what I mean. See this spike day here? Uh, let's play it back to here and go back a day. And let me just show you that if you had purchased a put, at the money put, just as an example, buying at the money put is $6,000, and the next day you lost $1,366 on that. So, don't trade coffee with a smaller account. Matter of fact, I'd suggest that you stay away from coffee until you've got a much more substantial size account. So we're going to play it forward again. Now in guts, what we're looking for or looking to do is to find a trading range, which we've done here, and we're going to sell a put and sell a call at the same price, and wait for a breakout or not a breakout, I'm sorry. Wait to see that it doesn't break out and stays in the trading range, which is kind of hard to do sometimes. But right now the price has been going sideways, and we want to sell options, calls, and puts that are overpriced, and that's something again that's hard to do. Usually, one will be fairly priced and one will be overpriced at the best scenario. Now we're looking here at a 240 call. You can see down here in the bottom a 240 call, and you can see down here in this screen that a 240 call is overpriced. This is the theoretical price, what it should be selling for, and you can see that it's overpriced. Why? It's because everybody has been watching this market go sideways. Everybody's either selling puts or buying calls or a combination of that, so options are expensive. Now if we looked at a put, a 240 put, you can see that it's overpriced also. So we have the best of both worlds. We have a put and a call that are both overpriced. So what we're going to do is sell a call at 240, and we're going to sell a put at 240. All right, so let's go forward. All right, we're filled, and commissions were $100, $50 per side or per option, and we're up $65. Now, in the best scenario is that the price would continue just going sideways, and both the options would expire, worthless, and we'd collect premium on both sides. Chances of that happening is pretty nil because we're not in a very big trading range. All right, but let's go forward. Now we're down 197. Now we're down almost $1,000. Now that would be my limit on a $20,000 account. Be 5%. Would be $1,000. So if it goes against me $1,000, I'm getting out. I'm saying that I made the wrong decision. 722 in the hole, 291. I don't like the dojis that we're looking at here. Spinning top followed by a doji. I'm going to stay in it though. All right, we're up 196. We're up 402. Stay in it. We're up 590. A little spike. We lost 40. We're down 47.50. Uh, so it looks like the market is bullish. Now, what we could do, since we're down 47.50, we could either exit the trade, or what else could we do? Think for a minute. If we wanted to stay in that trade. Taking cap time. All right, you probably figured it out. We could offset the put that we sold, or the call that we sold. I'm sorry. And we could buy back the call. All right. And that way we're short the put. And if the put expires, worthless, we collect all that premium. So let's see what happens here. All right. So we're down 47.50. All right. Now we're up to 85. And the reason being, the price is going up, and the amount, the value of the put that we sold is going down. So let's see what happens. We're up 153. We're up 1,053. All right, we've got a target. We risk 1,000, so I'm looking to make 2,000. All right, we're up 1,700. We're up 1,800. 1,897. Spinning top. Let's see what's happening with the indicators. Slow stochastic and MACD. I'm going to stay in it for another day. All right. Now, what could we do if we thought the price was going to come back down and we want to protect ourselves a little bit? Think what we could do. We could sell a further out call. Let's see about doing that. We could sell this call for $1,000. Let's do that. Let's sell this call for $1,000. All right, so it's going to give us $1,000 worth of flexibility for this one to come. If it does come back down, at least we've got a cushion for $1,000. And if it continues to go up, then the value of the one that we sold down here is going to decrease. Hopefully this will expire worthless, and we'll collect that $1,000 in premium. All right, we're up 1873. We're up 2,000. I'm out of that trade. I've hit my target, so I'm going to offset all of these. That call, I sold it. I'm going to buy it back. All right, this one down here, we're short a put. I'm going to buy that put back. Or I could leave that put, and let it expire worthless, maybe. But if we had a big, downtrend hit us, then that put's going to increase in value. It could even go into the money. I'm out of this trade as of tomorrow, and I picked up, there's $2,000. And we're flat that market. All right. So anyway, that's how you would use a gut, and a little bit more. Obviously, the perfect gut would be that you had a wider trading range. I'll give you an example. If you had a trading range like this, that was this wide, a big range, you sold right in the middle, a put and a call, then it came over here and it expired, and you collected premium on both. That is not what happened on this trade. So we did the best that we could to take care of some of the losses that we could have incurred, protect the profits that we did make. We made $2,000. We risked $1,000, so we've made our 2-to-1 return. Now we're going to go on to the next trade and see what happens, or look for another trade, obviously. Now the next video, lesson 35, and that one is on conversions, and I think you'll find that one interesting. Take some time, go out and look at some charts and practice some of these guts, get a feel for how they work. Don't start trading real money with them until you've practiced and practiced and practiced, and you're consistently, making money. And that goes for anything that's covered in the course. Don't just jump out and put something in. Practice with them first. Take care. I'll see you on the next video.